I see a lot of mistakes that investors make over the years, in 35 years. And the great thing I have about myself is I haven't really changed the way I feel about most of this. I haven't suddenly said, suddenly AI has made everybody better stock pickers. And I don't believe that's true either.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street podcast. I'm Jim Worden, CIO for the Wealth Consulting Group. I'm joined by my co-host, Jimmy Lee, CEO, Talley Leger, our Chief Market Strategist, and we're delighted and super honored to have with us today Bob Pisani. Bob, welcome.
Thank you, Jim. Pleasure to be here. Sorry about the sirens going by there, but that happens every time I go on air. Actually.
No worries. We're thrilled to have you. So I guess want to kick it off. Reading your bio, you started off as a physicist, and then you're a real estate developer, and then you became a reporter, not an analyst, but a reporter, and you want to report on what is actually happening, not predicting anything. Tell us about your journey.
Well, it's long. I'm almost 70 years old. So it consisted of one long period of work and one very lucky break that happened to me. I grew up I was born in New York, grew up in Philadelphia and suburbs. My father was a real estate developer in the 60s and 70s and always wanted me to go into the apartment building business with him. And I wanted to do two things when I was young, and I mean a teenager. And one was I wanted to be a physicist. I was very good at mathematics and physics. And secondly, I wanted to be a writer. I wanted to be a journalist. I wanted to be a book writer. I wanted to be Norman Mailer, Gay Talese, Tom Wolfe, Hunter S. Thompson.
Wow.
They're names of famous people in the 60s and 70s when book writers were intellectuals. That's not today. Today, an influencer is somebody who runs a TikTok page. So things have changed, but That's what I wanted. I went to school for physics for a number of years and left because I was a mediocre physicist, and tried for several years to be a freelance journalist. Was moderately successful, but in 1985, my father started teaching real estate at the Wharton School at the University of Pennsylvania. He knew the head of the real estate center there, and he brought me in to help him run the course on fundamentals of real estate development. And we wrote a book on it that John Wiley published in April 89 by sheer dumb luck. That was the month CNBC went on the air, April 89. And makes the long story short, I was on as a guest. I knew some of the early producers there at CNBC, and they hired me as the real estate correspondent in the summer of 1990 after CNBC had been on the air 1 year. Cable business was in its infancy. There was very little in the way of any kind of viewership, but it grew very slowly and steadily. And I was the real estate correspondent from 90 to 96. And in 1997, I became stocks correspondent. And I became stocks correspondent because the market was going up and we were getting ratings for the first time. And what had changed everything for us was not me being the real estate correspondent. It was the Netflix browser. That happened in August of 95. And all of a sudden, three things happened. One was there was a shiny new object, the Bitcoin of its day, called the internet. And there was something to talk about. But there had not been a lot to actually invest in that was a very specific internet-related investment. And Netscape proved to be that one thing. That was the moment where everyone said, here's something that you can buy, a browser directly connected to this shiny new thing called the internet that's pure play. And it had been very hard to find that up until then. And the stock just took off and went nuts. So number one, you had a shiny new object. Number two, you had a specific event that occurred that allowed you to invest in that shiny new object. The third thing you had was some forum where people could discuss this, and that was CNBC. That was live trading. And we were there for that. And that kind of helped make us, that whole internet moved to the upside. So it's a little bit of an exaggeration, but in the summer of 1990, when I started, we had almost no ratings. And at the end of 1999, we were the biggest thing on television. It was quite a wild ride, those 9 years, where you go from total obscurity to 1999, people are shaking your hand walking down the street. And believe me, it was quite a wild ride. So there's a little bit of dumb luck here in that I knew people at CNBC when it first started, and I was teaching real estate, a skill set they wanted. They wanted someone to report on real estate. But I tell people, even though that was obviously a little bit of luck for me, you're not a leaf blowing around in the wind. I saw that opportunity and ran with it. And I don't know what you guys are good at. I always say, what's your real skill set? What are you really good at? And what I'm really good at, people say, oh, well, you're an expert on the stock market. Yeah, I am, but that's not my skill set. What I'm really good at is I'm really good at writing. I'm really good at explaining complicated things. I'm really good at research. I'm really good at interviewing. There's a fourth component here. I'm very good talking on my feet. I'm very good speaking extemporaneously in front of crowds. I could do this when I was a kid in grade school. The teacher would say, Bob Pisani, come on up here and tell us what you and your buddy Charles Sachs are making fun of in the back room there. And I'd stand up in front of the class and go, all George Carlin on them. So you have to know what your skill sets are. And the minute I saw that job at CNBC, I said, that's something I'm really good at. Talking on extemporaneously without a camera or without a prompter, doing research, doing writing, it hit my skill set. So I stayed for 35 years and loved every minute of it.
That's incredible. I remember just many, many years ago starting to watch CNBC, and you're a legend, by the way. You'd be walking up and down and the camera would follow you and you would just be talking to the camera. And I don't know how you walked without tripping, because you just stare right at the camera and you walk up and down the halls of the exchange. That was before you got on here, we were at Talley, and Jimmy and I were talking about some of the legends, Maria Bartiromo, Mark Haynes. You developed a great relationship with Art Cashin, and I'm sure many others. We had, by the way, we had Peter Tuchman on one of our earlier episodes last year, and that was fantastic.
He's one of the old stalwarts. There aren't many of them left. When I got there in '96, there were 4,000 people on the floor, almost all men. And it was a fraternity. It really was a fraternity. It was like a private club. In fact, it was a private club. The seat holders owned the New York Stock Exchange. It wasn't publicly traded at that time. And you come on the floor and there's 4,000 people there. And the problem was that most of them didn't trust the press. It was a private club. They were very leery about saying anything, very worried that somebody would turn around like me and go on there and say, I just talked to John Smith over there, and he said he bought 5,000 shares of Chevron. They don't want that. They don't want that kind of knowledge out there, because it could affect trading. So it was a very delicate situation. And one of the people that took me under their wing was Art Cashin. Art was the head of floor trading at UBS ultimately, but was with several firms before that. And he's one of those people. And I'll tell you, when you arrive on the floor, 4,000 people, and none of them want to talk to you, that's the definition of loneliness. And when somebody like him, who was a legendary person at that time, goes to people and say, this guy Pisani, you can talk to him. He's not going to go on the air and shout your name out and what you've been trading. He's trustworthy. And I knew I broke through in the summer of 2000, or when they invited me to sing carols on the floor with them. Wait Till the Sun Shines, Nelly is a famous Christmas carol. Yeah. It's sung during Christmas time. It's not a Christmas carol that they used to sing, and they still do. And in this Christmas 2000, they invited me to go sing with them, and I covered it on the air. And that was when I kind of finally completely broke through to everybody. But it took a while to build up trust on the floor. And you really build up your reporting chops when you have to report on the floor and you've got 4 or 5 minutes to say things, but there's no teleprompter there. You're talking off the top of your head. And you better be short, you better be entertaining, and you better be accurate. And that takes a lot of work. It's really kind of tough, making sure you've got the sequence right, making sure you make sense, making sure you're accurate, making sure you're a little entertaining. You're walking at the same time a lot of times, back and forth, trying to grab somebody. So there's a little bit of entertainment. There's a little bit of acting associated with the whole thing. And that's what I liked about it. It required several skill sets at the same time.
I love it. Talley, you want to jump in? I think you had the question.
Yeah, well, I mean, those are helpful reminders, Bob. Thanks, because we're in the media every week, sometimes several days of the week. But these are all things that we know and love about you, Bob. I was wondering if I may ask some things that our advisor audience may not know about you. I can see in your background there, you might have some old DVDs, maybe even some cassettes. Is it true that you're a fan of jazz? Is that one of your hobbies?
Yes, I've been into jazz since the early 1970s. And when I was at college, I had a roommate, and I was into Pink Floyd. This is 1973. And Dark Side of the Moon was out, Led Zeppelin, all of that, and of course, Dead. But he gave me 3 albums. One of them was Bob Marley's album. It had Natty Dread on it, so I'd never heard.
Natty Dread.
And the second one, I forget the second one. The third one was Kind of Blue by Miles Davis, and it changed my life. I put on a headphone, I listened to this. The other album he gave me was Bitches Brew, which was fusion. In 1969 it had come out. It was already 3 or 4 years old, but I listened to Bitches Brew, and it was like, Pink Floyd's Dark Side of the Moon on steroids. I said, this is the spaciest thing I've ever heard. And so I started getting into jazz. Eventually, we went to a lot of rock concerts in San Francisco, and I started collecting rock posters. So what you see here behind me is a few of these rock posters. There's a Led Zeppelin poster. That's from 1969 right behind me. So I started collecting them, in 1975 or 6. 1977, when I went to the last Led Zeppelin concert in the United States. In Oakland, and I've been collecting occasionally. It's a silly little hobby, Jimi Hendrix at the Fillmore, but it's a lot of fun because these artists helped create psychedelia, what we call psychedelia, and it really changed the visual arts a lot. And we're all, those of us who are deadheads are mourning the loss of Bob Weir, who died over the weekend, a rhythm guitar player. Grateful Dead passed away. He was a beloved figure. So there's been a lot of people playing Grateful Dead songs all throughout the weekend.
I'm sorry to hear that.
Deadheads there are on the floor too. Maybe not. They're all getting up there in age. There's not a lot of 20-year-olds on the floor anymore.
Well, the reason why I ask is I used to be a classical musician in a past life, and I wanted to ask you maybe from a jazz perspective. Do you think that there is a music to the markets, and when you listen, what do you think the markets are telling us right here from that perspective?
Oh yeah, there's definitely a music. If you mean by music, you mean a rhythm to the market. There's definitely a rhythm. The problem with that statement is it's true, but it's sort of like a rhythm that changes all of the time. So it's not like you're necessarily listening to a symphony. You're sort of listening, even on a daily basis, to pieces of things that can judge in and out. It's sort of like somebody who's in various states of emotions all throughout the day. And some days they want to hear something that's kind of fast and jumpy, and other things they want to hear slow and pensive. So yes, there's a rhythm. I don't want to take the analogy too far, but I'm a long-term guy. I'll tell you what changed my life. In 1996 or early 97, I became the stocks correspondent. The first thing I did is I called Jack Bogle, the head of Vanguard. Now, Bogle was just on the verge of leaving being the CEO. Jack Brennan was taken over from him. And I got him on the phone. And I said, I'm the new stocks correspondent at CNBC. I'd love to have a relationship. And he was famous, but not legendary. He was famous for promoting low-cost index funds. He had an S&P 500 fund. He was a bit of a curmudgeon. He was known to be a bit of a curmudgeon. I said, I'd love to see if we can get you on, but I'd love to just talk to you more. And he said to me, Mr. Pisani, he had a very professorial voice, Thank you for calling. It's very nice. I do appreciate you calling, but I have a lot of problems with your television station. They called it a television station, which was, anachronistic. So first off, we have a problem with having these fund advisors you have on. These people like Bill Miller from Lake Mason. Bill Miller was a big star back then. Now, and we had him on a lot. Now, this fellow, nice fellow, but you claim that he's had a big successful run over the last 3 or 4 years. That may be so, but you do understand, Mr. Pisani, it doesn't last, right? You do understand this? I said, well, yes, it's very difficult to find someone who outperforms. No, Mr. Pisani, it's almost impossible. In fact, it's statistically improbable. Do you know what the word persistence means? I said, well, it means they don't keep winning. Yes, that's generally what it means, Mr. Pisani, but I'm going to tell you more importantly, what it means is very simple. You can show that perhaps this Bill Miller and some of these other types that you have on, well, they may outperform for 3, 4, or 5 years. Now ask yourself the following question. Will they be the same people that outperform in the next 3, 4, or 5 years? They will not, Mr. Pisani. That means that's persistence. There is no persistence in there. So you may statistically get a few people who outperform in the last 4 or 5 years, but they're not the same people that are going to outperform in the next 4 or 5 years. Do you know what that means, Mr. Pisani? Tell me, Mr. Bogle. Well, it means that that this statistic that you're showing, these people that are outperforming, their outperformance is largely a matter of luck rather than skill. If it was skill, then persistence would be a regular basis. Do you understand that, Mr. Pisani? So I'm thinking, my heavens, I'm just trying to get a relationship going with this guy, and he's interrogating me. But he was right. And I called my wife and I said, I just talked to this guy, Jack Bogle. He's absolutely right. And he said, I'm going to tell you what, Mr. Pisani, I'm going to give you my personal phone number. I'd like to help educate you a little bit more. And I'm going to give you the name of a fellow who's my assistant. His name is Gus Sauter. And he helps run our indexing business. Gus Sauter became legendary for essentially really advancing the indexing game at Vanguard. And it began a 10-year, 11-year relationship until Jack passed away. And it changed my life. I called my wife that day and said, Suzanne, honey, this guy's right. I want to open a Vanguard account. We opened a Vanguard account. My wife is a real estate agent. We bought Vanguard REIT Index, buy what you know. And my wife still has that account. And that was September 97, began my whole relationship with low-cost index funds. I started looking into stock picking superstars and why they didn't last. I started looking into behavioral finance a lot more, which purports to show how people really act, not how they're supposed to act. As you guys know, people don't buy low and sell high. They do the opposite. Why do they act irrationally? And he was very big on trying to explain all of that. But that changed my life. And I essentially became a long-term buy and hold guy. And I spent years and years and years with active traders trying to figure out how did they work, and can the average person actually really outperform by buying and selling stocks on an active basis? And I very quickly concluded they could not, and became basically an index guy, and still am. So if you want to talk about that, I'm happy to do that. But I see a lot of mistakes that investors make over the years, in 35 years. And the great thing I have about myself is I haven't really changed the way I feel about most of this. I haven't suddenly said, suddenly AI has made everybody better stock pickers. And I don't believe that's true either. So we'll chat about anything you want here, but advice for older investors or mistakes I see investors make, whatever you want to talk about.
It's a great story. I love it.
Yeah, I got one for you. I started the business in 1995, and I've seen you on TV so often in my career. It was really, like you said, when CNBC took off in 1990, I guess, or 89, media's influence on the investor. And as a financial advisor, and looking at your notes, and especially with what you just said, we know that you believe in a long-term investment strategy, not trying to time the markets and those types of things. But how do you feel about the media and its influence on that? Because obviously the three of us have been on CNBC and lots of other media, and everyone wants to talk about the trade of the day. So what do you think about the media's influence on investors, generally speaking? Good, bad? I mean, the awareness obviously is helpful. We have a lot more people investing nowadays than back then.
Yeah. The question is, to what extent is the media a cheerleader for anything? And the answer is, well, it's the extent that anybody's covering. How can you, if NVIDIA is the biggest stock in the last 3 months and it's up 40% and it's now a $3 trillion company, how could you not report that? You would be remiss if you did not report that. That's noteworthy. Now, does the fact that you're reporting that and people will look at that and say, wow. So people have this mindset, okay, this stock is up 30%, and they make a classic investing mistake, a bias. It's called recency bias. They believe that because the stock is up, pick a number, 30% in 3 months, therefore it must be up 30% in the following 3 months. Of course, this is wrong. We know this is wrong. But the mere act of reporting this tends to create this impression in people's heads. Now, you can always say past performance is not indicative of future performance. You hear that all of the time. We say that too. But that doesn't stop people from being momentum investors. So, the answer is yes and no on this. Does it influence people? Of course it does. But how can you report this without making it sound like you're too much of a cheerleader? Now, if you go out and say, I'm buying, you should too, well, that's pretty obvious. Duh. Mm-hmm. But I can tell you this, I spent 35 years covering this business, and I always was very careful about reporting what was going on without me saying I'm investing in this. I did make it very clear that I own index funds. I made it very clear that I personally owned S&P 500 index funds. I didn't own individual stocks. I was restricted from owning them. I could only own the company that I was part of, and I could own ETFs and I could own mutual funds. So in the 1990s, General Electric owned NBC. They sold it to Comcast. And so the only stocks they ever owned was General Electric and Comcast, individual stocks. But other than that, I've owned index funds and some mutual funds. And so the game here is to explain to people as a journalist what's going on, and you can avoid crossing that line from saying, I own this and I think you should as well, other than making the generic comment about the value of owning index funds. So I hope that sort of answers that. You can't avoid reporting stuff that's going up more than other stuff. The problem is people they have a bias in their head, a recency bias, and you have to be careful of making sure they're aware of that recency bias that exists. Does that make sense?
100%. Yep.
So I guess along the same lines, you talk about behavioral biases. So there's recency bias, there's overconfidence, there's illusion of control, there's anchoring and confirmation bias. What are the the pitfalls that people fall into the most in terms of biases that you've seen, whether it's professional investors or people that are watching?
Yeah, this is a big pet peeve with me. In fact, if you ask me, this is the number one thing that has baffled me for 35 years. By the late 1990s, certainly by 98 or 99, the thing that I had noticed that drove me nuts was, why was everyone so bad at predicting the future? I mean, it wasn't just stock people, but everyone was bad. The weather forecasters were bad. Anybody who had, this is what's going to happen in accounting in 1999, they were all wrong. Analysts were wrong. Strategists had poor track records. Economists, even the Federal Reserve record of predicting the GDP 1 year out and inflation 1 year out was terrible. It was so bad. Powell was asked about this a few years ago, and he said, we have a lot to be humble about. That was his answer. And so you look at this, it's 1998. I've been there for 8 years, and I'm looking around saying, what the hell? We keep reporting like, oh, Goldman Sachs says the S&P is going to be up 12% this way. Well, and they're terrible. They're all terrible. Why is this? Why? It drove me nuts. I took out people for years and said, what the hell? How come you people are so bad at this? Why is its future so difficult to figure out? And so I wrote 2 chapters in the book about this, about what it's very instructive writing a book about your career and what you think you've learned, not what you talk to other people. But what do you think you know, Bob? How smart are you? So it boiled down to two things to me. Number one is that predictions are riddled with biases and noise that limit the quality of those predictions. So, for example, we talk about recency bias. You could have overconfidence. There's all sorts of different biases that exist that are out there. And that sort of influences overall what's going on and how you look at things. There's other ways of dealing with this as well. So you can look and say, I'm not sure what the future is going to look like, but I have a very strong opinion on things. So that's the biggest problem, your initial biases. And these biases literally infect your brain. They change the way you think, and they throw off the prediction level and the accuracy. The second problem that occurs is investors don't have a complete information because events happen that are unpredictable and they affect the outcome. So I'll give you an example that I always use: Caterpillar analyst. I'm just picking something out of nowhere. Caterpillar. So you got an analyst. This guy's job, it's December. His job is to figure out what's Caterpillar's cash flow and earnings and price might look like 1 year from now. Now, it's just one company. How hard could this be, for crying out loud? It turns out it's really difficult. Why? And they're all wrong. Why? They're wrong, besides the biases, because the multiplicity of factors that go into determining the stock price and even the earnings is vast. It's so vast that it's really difficult to create a model that forecasts the thing because you don't have complete information. So I'll give you obvious examples. There's the macroeconomic environment. You could go into a global recession easily. Something could happen, okay? That's impossible to predict on a 12-month basis. There is the microeconomic environment around specific areas where Caterpillar is involved in. There is managerial stuff. So the CEO could fall ill. The architect of the turnaround plan, something could leave for a competitor. The global construction business could suddenly change due to tariffs or trade wars or some kind of fights, particularly when dealing with a multinational company like Caterpillar. I could go on and on. The point is, when you actually tally up all the input points that go into making up the stock price of Caterpillar, predicting what those input points will be 1 year from now accurately is just about impossible. So when you look at this, when you say, okay, number one, we got all of these biases that are out there, okay? And we have people trying to literally change the way they're thinking because of these biases, and these biases infect their way of thinking, on top of the fact that we don't have enough information because we can't see the future to fill in all the input points that are going to change the point. All of a sudden, it becomes a little clear. Now, I'm simplifying this, but when I finally figured all this out, I said, this is why people can't predict the future. Now, it turns out you can make somewhat better predictions if you are aware of the biases more. And there have been efforts. I would particularly point you to one called the Good Judgment Project that's run out of the University of Pennsylvania, where they actually try to improve overall forecasting in general by using sounder investment principles like understanding biases. So it's sort of not impossible to improve prediction, but it's really, really difficult because of the way humans are set up and what they do. So I hope that makes some sense to you there. It's a real pet peeve. And once you realize that, you become a lot more humble. This is why I don't sit around and say, oh, I have a personal forecast for 2026. Now, you want my personal observation on the stock market? The S&P has had a series of years of way above normal returns, with the exception of 2022 when it was down, 18%. The S&P is also historically overvalued. On a historical basis, this would argue for subpar returns for the next several years under simple mean reversion ideas. So we've had better than double-digit returns 4 out of the last 5 years, and that is historically unusual. We have forward earnings estimates of 23 times forward earnings. That is historically high. That does not, there is no historical evidence that that is a sell signal immediately, but it does normally be associated with somewhere down the road, 1, 2, 3, 5 years, subpar returns. So does that mean the problem you have with this observation I just made is, what am I supposed to do with this information? Am I supposed to turn around and sell everything? What do you do? And the answer is, if you're a long-term investor, if you're a Jack Bogle guy, what you do is you have a plan. You say to yourself, let's be me, okay? Let's not be abstract. I'm 70 years old. This is in my book. I am planning to live to 90. How long are you going to, when are you going to die? This is a tough question to answer, isn't it? Try doing that. I'm working on 90, okay? My actuarial friends say, Bob, you should be 95. You should work at 95 because you're going to have medical advances. They're probably right. Let's work on 90. So I have 20 years. Suppose we have a subpar year. Suppose we're flat this year. Nothing happens in 2026 and nothing happens in 2027. Still, the overall returns for the last 10 years is still a little above normal. And I look at this and I say to myself, okay, what would it matter? I mean, 2022 is a terrible year. Nobody even remembers it. So you have 20 years. A lot can happen in 20 years. As a result, I have maintained a somewhat aggressive stance. I've told people I have about 70% of my 401k in stocks, 23% maybe in broad diversified bonds. It's 5-6% in money markets, somewhere around that. That's aggressive for a person 70 years old. But my attitude is, I'm not planning on selling stocks. I'm planning on staying long. I'm planning with the long term. I am actually anticipating somewhat lower than normal numbers here, but I'll be slowly withdrawing money over the next 20 years. So, you know, that's an argument to me to stay reasonably aggressive. We can talk about portfolio diversification if you want, but that's kind of the way I look at things right now. And I always avoid being abstract about this. This is why I tell you, this is what I own. Okay, this is what I'm doing right now. My largest holding is the S&P 500 index fund. And people look at me when I do that, and they're always disappointed. I say, you know, I own a small cap value fund, Vanguard. I own a broad diversified global, equity fund. I own a broad bond fund. I own money market fund. And they look at me and they say, that's it? They're always disappointed. They always want to say, tell us what you really own, Bob. Tell us the real shit. The leveraged inverse Malaysian bonds that, returned 150%. You have to own something that's crazy. You're the stocks correspondent for all these years. And the answer is no, I don't. Then they're always like, really? You own the S&P 500? Why wouldn't you own the S&P? That would be the core holding of any person out there. And yet people are astonished when I tell them that's what I actually own.
That's too funny.
Talley,
you were gonna ask a question.
Yeah, well, I'm just being patient and polite. I'm just enjoying the stories like you guys.
Yeah, love the stories, Bob.
So,
Okay.
Bob, as discussed, I mean, you've been reporting on financial news for 35 years now. I'm thinking of our advisor audience here. Those are our clients. So my question to you is, how should advisors kind of balance staying informed on one side, think of that as signal, versus avoiding the noise of the 24/7 media cycle on the other hand?
Yeah. Well, don't turn the news off. I don't. But you have to discipline yourself and discipline your clients not to act on everything. In general, the simplest way to explain this is trading too much creates mistakes. Generally, you want to trade as little as possible. And the problem is some people think that they have to trade a lot, and they don't. And they need to be educated about that. And that's the primary role of a good financial advisor. So look, it's very simple. I always say there's 4 components to investing. There's the return, risk, cost, and the time. And those 4 things you need to understand. And very small differences in returns make a very big difference. So that's why I say be careful about paying 2% to an investment advisor when if you can pay 1% or below, and people say to me who are 20 years old, what's the difference? It's only 1%. And when I show them 1% compounded over 30 years, they get it. So number one, remember the 4 components: return, risk, cost, and time. Very small differences in returns can make a big difference over many years. Don't time the markets. Don't say, to be right timing, you have to be right going in and you have to be right going out. And almost nobody gets that right. And you could demonstrate this to people very, very easily by showing people that there's like 10 days in the year when the markets really change. And if you're not in on those 10 days, your returns are terrible. And you have no idea what those 10 days are. And just showing people the return difference on the top 10 days versus and then pulling that out, they'll go, oh, heck, if I wasn't in on those 10 days, my returns, I make 20% on the S&P. If I'm not in on the top 10 days, I'm only making 6%. Right. Now you tell me what 10 days those are. I don't know. Well, neither do we. So you have to have a plan and stay invested. That's the point. So the other point I would make is most investors are best served by keeping costs low, owning index fund, or at least low-cost actively managed funds. Bogle was never against active management. He was against high-fee active management because the high fees destroyed any alpha that they did.
Makes sense.
So those are the biggest things. I mean, in terms of mistakes people make, people think they know how to pick stocks. They don't. People think they know how to time the markets. They don't. Almost all active fund managers do not outperform their benchmarks over time. They don't. Most investors are better off in low-cost funds. So in terms of like advice, if I was an RIA, I would give, you need to educate them on the long term, a long view. It's very simple. 3 out of 4 years, the S&P 500 goes up. And declines of 20%, like we saw in 2022, is 18%. It is very uncommon. It's happened 15 times in the last 100 years in the S&P. Only 15 out of 100. 2/3 of the time, drops of 20%, which is what everyone's afraid of, you're made whole within a couple years. And drops of 10% are fairly rare. The S&P 500 goes up 10% or more 57% of the time in the last 100 years. It only goes down 10% or more 12% of the time. Think about that. What that mean, you don't even need to know statistics. All you need to know is, heck, long term, that's a winner. Maybe not 1 year or 2 years, but long term, the S&P is up 3 out of 4 years. It's up 10% or more 57% of the time. It's only down 10% or more 12% of the time. Heck, you don't need to know a lot of statistics to understand long term, that's a winner. You don't need to know any more than that. You just need to stay in the market consistently. The other thing I keep telling people is you're going to live a lot longer than you think. I'm being very specific about me at 90. I think they're probably right at 95. So if somebody comes to me and they're 35 years old, I'm going to say, and they say, what do you think is going to happen to the S&P this year? I said, well, I'll tell you what I think, but I don't know why you would care. Why is that a worry to you? You're going to have 60 years. You're going to be alive. You're 35 years old. You're going to be alive till 95. Do you think anybody is going to worry about 2026 even 5 years from now? I guess not. Okay. Well, then why don't you start thinking long term? Think about your plan. Think about how much you want to risk. Think about staying in the market. This is the final point. You can take more risk than you think. So people are surprised when I say I'm 70 years old. I have 70% of my 401k in stocks. People not think about total portfolio. So when you think about it, you might have a retirement fund, you might have a 401k, but you also have a home, you also have Social Security, you also have other things. And when you think of your total portfolio, Social Security is an annuity. It's an inflation-adjusted annuity. You can stand a lot more risk. I don't have 70% of my total net worth in stocks. If you include the house I own and a few of my rock posters, it's less than 70%. So you can take more risk than you likely think overall. So I hope that makes some sense.
Bob, you have a hard stop in a few minutes, so just one more question about a couple observations. Number one, you don't look your age. You look phenomenal, so you must be a happy guy living a great life. 2, if you get too bored in retirement from CNBC, you could be a phenomenal financial advisor. So if you ever want a part-time gig, let us know.
I set up LLC. I set up Bob Pisani Consulting, so you can go on my website, bobpisani.com, and take a look. And like I said, I'm doing a little consulting and lecturing and emceeing, love to hear from anybody.
And I think we agree with most of what you're saying. We may have a little bit of a debate on the next pod you come on about active versus passive. But that being said, can we finish with, that story you were talking about with Mr. Bogle is phenomenal. I don't think a lot of people know about that. Are there any other stories like that you could share that impacted you?
People, when I wrote the book, my publisher called me up and said, I want to buy the book. I want you to tell stories. I don't want you to give a financial history lesson, but if you do, use stories. And he said, people love celebrity stories. And they said, I need a title. And I said, well, I want to call it Lessons on Life and Investing from the Floor of the New York Stock Exchange. He said, great. That's not a title. That's a subtitle. I need a title. Tell me, when you're standing on the floor and they're waiting to go on the air, what does the producer say to you? I said, well, they say, hi, Bob. Kramer's talking. Carl's going to toss to you after that. You have 5 minutes. Generally, after that, there's only two things you hear from a producer. One is the word wrap. The word wrap means shut up, means stop talking. Sometimes they'll say stretch. The word stretch means keep talking. So basically, from producers, you can hear a lot of things, but basically it's some variation on shut up and keep talking. And he said, that's it. That's the title of the book. Shut up and keep talking. You'll have to explain what that means, but it's a great title, Bob. Love it. So you want to know, one of the great things about being on the floor is the bell ringings. The opening closing. I saw probably 14,000 bell ringings from 1996 to 2025. And most of the time, you're not interviewing the person ringing it, but you do get access to them. So what's it like to meet all your heroes? This is what I tell people. Why did I stay all these years, 30 years on the floor? What would you give to meet every rock star, every CEO, every king, queen, anybody? Yeah, I met everybody. And even though you're not interviewing them, there's the CEO of Chevron standing right there. And he knows who you are. The PR people around him, but you can say hello, talk to them. And every once in a while, somebody says something to you that's really interesting and surprising. So one day, Barry Manilow comes on the floor. The singer, Barry Manilow. Now, I'm not a Barry Manilow fan. I am a Led Zeppelin guy, for Christ's sake. I'm a rock guy. Look, I got psychedelic posters. But there he is. He rings the bell, and he's there to promote a new album. And that's what a lot of these celebrities are there to do. A new movie, a new album, something like that. What you learn about these people is what they really care about is generally not what they're actually there for. There is something that they'd love to talk about, but it usually is not the thing that they're there for. I know that sounds silly, but so we do a quick courtesy interview with him. He was there. I didn't do the interview. My colleague Bill did it. But he comes off, and the place is empty. It's 5 o'clock, and there's nobody there. It's just me and him. I'm literally standing there. And I just decided to take a chance, walk over and say hello to him. What the hell, Barry Manilow? Hello, Mr. Manilow, Bob Pisani. I'm the floor reporter here. Hi, Bob. So listen, I understand you used to be a jingle writer, right? You wrote ad copy. He said, oh, yeah, in the early 70s. I was really good at it. I said, so I understand you wrote the State Farm commercial. Is that right? Like a good neighbor, State Farm is there. He said, yep, I wrote that. $500. And that's all I got for it. And it's famous. And I'm very proud of it. And he said, I did a lot of other stuff. Did you know my Band-Aid commercial? He started singing this commercial. I forgot. I'm stuck on Band-Aid, Band-Aid stuck on me. He started humming this. And then he starts humming other things. And I'm thinking, this is kind of cool. Barry Manilow's just sitting there humming tunes that he wrote a million years ago that nobody hears anymore. So then I said, you just sold out Nassau Coliseum in Long Island. This was 10, 12 years ago. 19,000 people, a sellout. And I said, I can't believe that. You haven't had a big hit in a long time. How'd you do this? And he said, I know you think that I haven't had a big hit. And I said, he said, you're right in terms of chart hits. But what you don't know is I've sold many, many albums. I've been a big album seller for a long, long time. And what I did was, even after I didn't have big chart hits, I continued to do album sales very, very well and had a very loyal fan base. And what I did was I kept at what I really love to do, which is do tunes, Broadway tunes, show tunes, everything under the sun. And I just loved the business. And I had a loyal fan base. And he said, what happens, Bob, is you go through this middle period where you keep chugging along doing what you're doing, but you're not as famous as you used to be. And then suddenly you're at it so long that some reporters start calling up and saying, my heavens, you've been doing this for 40 years. And they start saying, you're a legend. And he said, Bob, then you have a whole other career. And it struck me like this is a very interesting commentary for him, because that's happened to him. It happened to Billy Joel, too. Suddenly they were nobodies. Well, not nobodies. They were around. But all of a sudden they got a second wind because people started saying, look how long they've been around. So Here's the point. Barry Manilow, I did not expect to say anything very interesting, but he had a very interesting commentary on the arc of his career and why he stayed and the value of continuing to stay at what you're doing. This resonated with me because at that time, this is like 12 years ago, I had already been there for 25 years. And I was, the hard part is the middle part of your career when you potentially can leave, but I didn't want to leave because I liked it so much. The same as Barry Manilow. And I love being on the floor and talking to celebrities and talking to traders. So I decided to stick it through in the middle. I'm talking like 2000, 2005. And because I didn't want to change, there was no reason to change. And the same thing happened to me because people said, gosh, you've been there so long. Look, you wrote a book and all that. So the point is, Barry Manilow had a very wise observation on the arc of his career and anybody's career and the value of staying at what you love. And then all of a sudden on the other side, you have a certain reward because people start looking at you in a slightly different way. Wow, you're like famous. You're part of the whole thing. So who knew? I mean, I wasn't expecting anything from Barry Manilow. And the guy turned out to be very, very thoughtful. And that conversation lasted, it wasn't 20 minutes. It probably was 15 minutes. It might have been 20. But that's as long as the conversation lasted. And it really resonated with me. And I put it in the book. Like, what a pleasant surprise. There are other little anecdotes about meeting Robert Downey Jr., Aretha Franklin, whole bunches of other people in the book who occasionally just would come up to you and say things that you wouldn't really expect. That was the fun of doing it. That made up for all the hard work and trying to figure out and understand.
What a great way to end the pod. Thank you so much. Great story, Bob.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.